Mr. Athey, good morning to you. So you're in there, we're going to have a slightly harder landing camp than most. Contrarian as ever. Good morning.
Morning, Manus. Yeah, not necessarily by design, but it does often seem that way, yeah. The historical record says that soft landings are very unlikely. You know, if you go back and look at Fed transcripts and news reports, there was a lot of talk of soft landings in 2007 as well, and we know how that ended. The two oft quoted historical analogues for soft landings, which are the early to mid 90s and the 60s, really do not bear a scrutiny when it comes to the comparison from a macro standpoint. The 90s, which is obviously the most recent and possibly the most relevant from a market perspective, unemployment was falling throughout that period from a relatively high level, around 7%. That's obviously a significant economic tailwind, and that makes it a very different scenario from today where unemployment is rising. So the fact of the matter is that the Fed, like all central banks, is looking at data today, which tells it something about what the economy was doing several months ago, and it's trying to make decisions about where the economy will be in 6, 12, or 18 months. And that's obviously very difficult, hence why the soft landings are very rare.
The one thing I love about bond traders and bond brokers is basically just the sheer absolute self-belief. We were so far away from the Fed at the start of the year, and we are still so far away from where the Fed wants us to be. There's a musculature in terms of the positioning in this bond market. I mean, there's real flex in this bond market. They are paying for significant rate cuts for a hard landing, the size of which are for a hard landing, not a soft landing. So with that in mind, do you think the Fed today, Powell, needs to walk us back from that appetite for 50? Is that his mission today, or what is the objective today?
The risk of being a little disagreeable, Manus, I'm going to say
Please
I don't think the market is at all priced for a hard landing. Quite the opposite. I think a couple of hundred basis points. The market's priced for, what, 230 basis points or so in totality. That is taking us roughly back to neutral. As Mohamed El-Arian has pointed out, we don't really know, and the Fed doesn't really know. But roughly, that is where the Fed is telling us at the moment neutral is. So if we see 2 to 250 bips, that would be in keeping with a soft landing in order to ease policy relative, to neutral. In order to support the economy in a recession, the Fed would have to go further than that. So what the market, in my opinion, is doing is looking at the probability distribution. The right tail has been severely clipped and curtailed. The chances of us having a re-acceleration that pushes inflation meaningfully higher in an environment where the labour market, by all metrics, is softening to varying degrees depending on which data you look at, but by all metrics the labour market is softening, and that obviously reduces upward wage pressure, and that reduces the ability to get that self-fulfilling price wage spiral. And obviously that's what the Fed is looking at. The market, however, is therefore saying, well, if the right tail is clipped, there is still some percentage chance, banks have it between 15 and maybe 35% chance of a recession. And in a recession, the Fed normally, traditionally, on average, cuts around 500 basis points. That distribution of probabilities means that there has to be some downward skew relative to even the Fed's own modal forecast.
Okay, so the right tail has been clipped. Let's get to market action. There's a couple of different things going on here. I want to square away the dollar. You say on these dips that we've had and the dollar's given back pretty much all of this year's gains, you're reloading up on the dollar. Why?
Yeah, the dollar serves two masters, obviously. I like Mr. Jen's dollar smile framework. I think it's simple, but it's very effective and very accurate in describing the dollar's behavior. So we found ourselves in the middle of the dollar smile. The market likes that because it tends to support risk assets, and obviously the market tends to be positioned long in risk assets. From here, there are possibly two outcomes, we would say, in the sort of short to medium term. One is that, as we've already talked about, 33 bips priced for the September meeting looks too much. Potentially 100 bips by year end looks too much, and potentially either the Fed or the data will cause the market to walk that back, and that should support the dollar via higher rate differentials. The other alternative really is that at some stage we do find the data deteriorating more meaningfully, and we do find ourselves in a more aggressive rate cutting environment, but history says that tends to be accompanied with risk off and a flight to safety. So we're in the middle of the smile, but we think the routes to either end of the dollar smile over the short to medium term are actually quite easy to get to.
Can I take the other side of that trade? If you're a buyer of the dollar, are you a seller of the yen? And do you believe, as Ven just said, is that the market, not me, the market has mispriced the proclivity for the Bank of Japan to get through more rate hikes in the autumn, which I got to say is not what I'm hearing from people on my IB.
No, quite the opposite. We like the yen. We have done for a while, and we've been adding to our long yen position. We're doing that on the crosses rather than versus the dollar. So we've been short sterling yen and we've been selling euro yen recently. Again, it's a fairly straightforward argument, which is that there's obviously quite meaningful policy divergence.
Yeah.
The Bank of Japan is trying to be hawkish. Other central banks are trying to be dovish. But again, underneath the hood, all this talk of carry trades really, I think, has focused on the most short-term investors, those that are most reactive, who have, I'm sure, cleaned up significantly their yen underweights, their carry trades. But the more meaningful position is that sort of implicit carry trade, that implicit yen underweight, which is large institutions globally and large institutions in Japan. And as the hedging cost sort of calculus shifts, as JGB yields rise relative to global yields, investment choices from those big institutional players should shift through time, and that should be supportive for the yen. And if we get a big period of risk off, obviously the yen being structurally underweight and being a safe flight to quality currency should rally hard.